We are officially live on YouTube for the Thursday edition of the Not Your Average Investor Show, the JWB Real Estate Portfolio of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC, because of his genius concepts, because he knows how to generate cash flow, because he's the great co-host, knows how to use that mic, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And with us, as always, we call her MTM because she brings us the moments that matter. And because around here, we call her Madison the Magnificent. Say hello, Madison.
Hi, everybody.
Madison is here to help you out in the chat. If you got any questions, anything like that, she's here to facilitate that. And we're here to give you advice. And the number one advice I can give you is that if you want to get really familiar and really comfortable with this asset class of rental property investing, GC and I put a whole bunch of work into a 2-hour class that is going to take you from I don't know that much about it to I know a bunch about it. It's going to take you from I know a little bit about it to I know a lot more about it. It's going to take you to I know a lot about it to like, oh man, I hadn't even thought about that. That was really worth my time. GC, tell them where to find this class.
Simply, if you're interested, listen, there's a relatively small part of the population that gets fired up for a title of a show called Using a 1031 Exchange, right? That's what we titled the show. But you know what? You're here and you're fired up about that. If you're fired up about that and you're fired up about the portfolio that we put together here on the show, you're going to be fired up about this class. And this class is going to take you from 0 to 60, whether you're a brand new investor or whether you're an investor who maybe has 3 properties and you want to get to 5 or 10. This class is built for you. So go to notyouraverage.com, notyouraverage.com, and enroll. We would love to see you in the party.
Yeah, man. Over 250 people in there. And we say it's less than 2 hours because it's very digestible. But you know how, what was it, Ernest Hemingway that says, I would have wrote you a shorter letter, but I didn't have the time. We took like 6 months to put this thing together. It's only the stuff that you need. So go to notyouraverage.com. We promise you it's a good time. And you're going to giggle a little bit because we have a good time when we do anything.
At least we did. I mean, I don't know if you are, but we had fun.
Yeah, that's right. And then once you take that class, you get to show up. You're so comfortable that you get to check in the chat and be part of what you see.
The roll call, baby.
Oh, we got Davis first with a
Big Suey.
We got the ringmaster of the Not Your Average Investor Show community.
Drew Barnhill.
We got Big Papa in the house. We love it when he calls in Big Papa.
When he calls in Big Papa.
Greg's dad throwing his hands up in the air. We got the early bird.
Mr. Dean Curry.
Mr. Dean Curry from Columbus, Ohio. We got somebody with a Feliz Día de las Propiedades a todos.
Fantastico. Bill Shields,
Bill
baby.
Shields. Bill Shields is Feliz Día del Portafolio.
Oh, sí, portafolio.
Portafolio.
Oh, very nice.
We got our usual leadoff batter batting 5th right now.
John Henning.
What's 5th? It's the cleanup is 4th. 5th is the
I don't know.
5th is 5th.
5th.
Yeah. Thank you. Appreciate that. Appreciate the clarity. We got the MVP of the community.
Mr. Lee Bishop.
Mr. Lee Bishop. We got Lita Song is back. Lita, love having you back here.
She's becoming a little bit more of a regular there.
Becoming quite the regular.
We love it seeing it, Lita.
I see it. We got the shaman from the Not Your Average Investor community.
Nadeem Shah.
Nadeem Shah, the shaman. Who else we got here? We got the mailman.
Billy Green.
And Billy Green. Good morning from the mushroom sprouting mountains of Colorado. Billy Green.
His calls on the mountains of Colorado are just spot on every time.
We always know the most important thing in the mountains of Colorado, thanks to Billy Green's attendance here. We got Hervé Francois.
From the Dirty Jers.
From the Dirty Jers. What up, fam? Good to have you in the house, Hervé. Who else we got in here? We got Jillian Noel is back. Hello.
All right.
It's a timely topic, says Jillian.
Fantastic, Jillian. You must be thinking about a 1031 exchange. We're happy to have you.
Make sure that you use that Q&A, pepper in any questions you may have. We got the second family of the Not Your Average Investor Show, our regulars, Rosalind and Gary Riley from Marietta, California. We regard you. Man, we really got that one right.
I feel like we're nailing this today.
We got Peggy Garnett in the house. New name.
No, Peggy's a client of JWB, but it is a new name here. We are so happy to have you, Peggy.
Peggy is obviously a client of JWB. She just says, hello, rent collectors.
That is something we do among many things.
We got the karaoke witness in the house.
Deborah Schwartz.
Good to have you back in the house. We got the first family of the Not Your Average Investor Show, the matriarch and the patriarch, Ken and Carolyn Malene. We salute you. Who else we got in the house? Man, we are killing it today.
Yeah, I feel really good about this.
We got Marilyn Cotterman in the house. She's from Homosassa, Florida.
Home of the manatees, of course.
She says, good afternoon, NYAIS Cool Club family.
There we go.
Love that. It's Cool Club for sure. Speaking of Cool Club, our favorite name to pronounce, Aaron O'Neill.
Into the lights.
Good to have you. We got John Lopez saying, hola todo.
Hola todo, John Lopez.
Nuevo nombre.
Sí.
Bienvenido, John.
Bienvenido a la fiesta.
Hope you make it a habit of hanging out with us. Dean Curry says fifth is the bat boy. I don't know. We got David Bladder back in the house from the Republic of Massachusetts.
All right.
The People's Republic of Massachusetts. I'm sure there's some kind of inside joke in there.
There we go.
All right. We got somebody saying howdy from New Jersey. Not your average guest. I'm assuming that's Greg number one.
Well, the better Greg?
The better Greg.
Oh, of course.
He generally checks in with a howdy from New Jersey, but if you check in with your text, it just says not your average guest. So not sure who you are unless you tell me your name. Layla Powell is back in the house.
JW teammates representing strong.
Layla. We got Gerald Schwartz in the house.
Gerald from Herald.
Gerald from Herald.
Gerald from Herald. Where?
Gerald from Herald. We Herald.
I hope it rhymes.
Gerald from Herald. All right, Gerald. Good to have you in the house as well, man. Gerald's come a couple of times. I remember the Gerald from Herald moniker.
Oh, there we go.
Good to have you as well. All right, GC. Let's jump right into it with what I like to call my favorite segment. And that's when Madison shares good news. What's the good news, Madison?
All right, everybody. It's really funny that Peggy puts in the chat that we are rent collectors because that has a little something to do with my good news. So every month, Tara, mother of the data flywheel, we love to track some things. One of the things we track is how much rent is collected and how much rental income is paid out every month to you all. So in July, we paid $4,792,655.22 to you all. You all earned over $4 million in rental income just in July.
That is a lot. And you know what? That we even collected more rent than that. We've eclipsed the $5 million threshold, I'm sure, because what JWB does is we collect the rent for our owners. We take our property management fee and we send out the distributions to our owners. So if we're talking about collecting $5 million roughly of rent a month, we're some rent collectors,
We're also
that's a lot of rent to collect.
Up and here. Every time that we bring the stat up and we continue to update it and we get closer and closer to like giving out $5 million, I'm always like, God, I don't even have a $1 million business. You guys are just in rent collection. You have operationalized.
Oprah, you get some rental income. You get some rental income. You get some rental income.
That by itself,
to track it to the cent.
And to track it to the cent. Track it to the cent.
A lot. Our accounting team's incredible.
It's pretty awesome. You mentioned Tara. I think it's funny since we had the JWB highlight team show. I saw Tara's Mickey Mouse backpack hanging around. I was like, I know who this is.
Yeah, there you go. Huge Disney fan.
Huge Disney fan. All right, Madison. You know what I like to call that, right?
Good news.
I like to call that good news. Thanks for sharing.
Of course.
And now, as we move on to the news of the day, we got a little bit of. We got some breaking news. GC, what's the breaking news?
The breaking news, hot off the press. We have some more good news to share here. My business partner, Alex Safakis, Mr. Downtown, as I like to affectionately call him. He really doesn't like it when I make nicknames up for him. So let's make sure we call him Mr. Downtown, just within our little community here in the social network.
I will 100% add that into his next intro.
There we go. He really doesn't like it. I have a pretty big platform now to really come up with nicknames for him. So we're going to call him Mr. Downtown. And Mr. Downtown, of course, is making his nickname just all the more relevant. He was invited to speak at TEDx Jacksonville for the topic of none other than downtown Jacksonville. It's actually called Downtown, a City Rediscovering Its Center. And the topics du jour will be the future of downtown Jacksonville, why this era will be a defining one for our great city, and the challenges and the opportunities that lie ahead. So we're super excited. Obviously, Alex gets invited to speak routinely. He has become one of the key influencers of downtown. He gets asked to speak quite regularly. And I think TEDx is a pretty cool opportunity.
It's a really cool
I know you're excited about this.
I'm excited and also jealous once again as a speaker myself that like getting invited on a TEDx stage, you have to be doing something really significant that's measurable, that's also innovative and impactful. And the idea that you get invited to a TEDx stage to talk about what you're doing is kind of like this big pinnacle of speaking accomplishment, man. So the fact that he gets to do this, I'm going to it for sure. I will be there. I will do as much reporting behind the scenes as I can for the JWB fam. But amazing, man. It just goes to show the significance of what's happening in Jacksonville as a subject that TEDx would want to highlight this whole thing, because this is a blueprint, right? This idea of burgeoning downtown as an economic windfall for many people involved, not just real estate investors, but all stakeholders involved, is a real thing that other cities are trying to emulate, And it feels like right now, Jacksonville is the darling of the ball,
Mhm.
and it's getting its moment in the sun. And we know what that means, GC.
Yeah, absolutely. For investors in real estate, especially those who own properties within, call it 15 miles of a downtown, you look at those other examples of successful downtowns and the investors who invest in workforce housing, like we all do here as JWB investors, stand to profit handsomely from this, because what this does is it raises median incomes, which is wonderful for our entire community here in Jacksonville. And then over time, what that does is it raises rents and it raises home prices. And that's where your profits come in. So, this is, and I think this is wonderful to see, this message of downtown Jacksonville clearly is living beyond what we advocate here on the show, right? When you start to see community organizations, I asked Alex, I was like, man, how often do you get invited to speak about downtown? He's like, I turn down way more than I accept.
Yeah.
He literally gets asked to speak on this probably once a week, twice a week.
Yeah.
And he can't handle all those speaking engagements. So it's a living, breathing thing when you're going around the city here, and some of the speaking engagements that I get to do and meeting with investors. The perception, I think, is the last thing to change for the locals here. When you're so close, it's the last thing to change, but it's changing even for the locals here. And so I'm really excited about it.
And once it changes for the locals, that historical home price appreciation rate that has been, at 4.6 and climbing because of how well things are doing, it has been proven to change, to bend that curve, right? Like once the locals get in on this idea of downtown is real, this is about to happen, then it's like all hands on deck on who can acquire as many properties as possible. So it's like a really, really good time to get in before that is happening. Right now, it's like the stock tip of the century kind of thing for a real estate investor.
The locals' perception is the last step of this entire equation to happen.
Correct.
So if you're waiting for that to happen, the big opportunity to see overall better gains than what you might otherwise have, that ship will have sailed if you're waiting for the local perception to actually change. So yeah, so this is a big opportunity. The event is sold out. So that's some bad news. I know some folks are asking when it is. It's on Monday. The event's sold out, but I did ask Alex to give us some behind the scenes things. I know you'll be there as well. So we'll have some stuff in the Facebook group if you guys would like to kind of take part in it as much as possible, even though you can't go. So if you want to see that, just go to jwbfacebookgroup.com and be a part of it.
Yeah, we haven't plugged the Facebook group in a while, huh?
Yeah, thought it was a good opportunity.
JWBFacebookGroup.com. I can tell you, I barely got in. By the time that I found out about it,
You were waitlisted.
It was already sold out. It got waitlisted. I was like biting my fingernails. I was trying to see who I could get a hookup from, but I got off the wait list. I got a ticket. I'm going legit. Wife can't come with me because I only got one ticket. But,
There we go.
No big deal. That means that I'm going to be Johnny on the spot reporter. All right, GC, let's move into we got another breaking news. Speaking of people that like to speak at things.
Oh, yeah.
I'm going to be speaking in a conference in Denver in a couple of weeks. And because I know that we got a great contingency of Not Your Average Investor fam over there in Denver, I'm going to have a little impromptu meeting on August the 20th at 7 p.m. at the Denver Central Market. Just if you're in the Denver area and you want to come to that, I would love to see you there. I know Billy Green's out there. I know Leslie Wilson's out there. I would love to hear from y'all. I'm going to be there no matter what. I'm bringing together multiple kind of like units of my network, but I would love for the Not Your Average Investor Show community to come out. So that's August 20th at 7 p.m. Denver Central Market. If you're here on the show right now, shoot Madison a message so she can just put me in contact with you and I'll contact you directly. I would love to share a meal with you. It's a food hall. So it's going to be, real
awesome.
Casual. People can get whatever they want and come meet together at a picnic table, get to know each other.
That's awesome.
But I'm
man.
dying to hang out with the Denver.
We have such a great contingent in Denver. I remember one of the last times we did one of the meetups on the road, the traveling tour we had in Denver, and I saw the video afterwards, and we just had some special friends and connections out there. So I'm excited for you guys.
Yeah, me too. I'm excited. And I'm already over the fact that the Denver Nuggets beat the Miami Heat in the NBA Finals.
Yeah.
I'm just happy to be there, folks. I'm happy to be there.
Yeah. Jokic is a good guy to root for, though. I mean, he's a nice champion.
I'm a fan of that team.
Yeah.
It's a good team. Just wish it wasn't against my team. But anyways,
Sure.
I hope to see you all in Denver Central Market, August 20th, 7 p.m. Hope to see you there. Bill Green, I see your number in the chat. I will store that and I will get in contact with you and anybody else that's coming out. Would love to see you there. I will share my information. All right, GC, let's jump into a little bit of the Q&A. We had a bunch of Q&A left over from last week.
Love it.
So not from last week, from Tuesday. Let's kind of jam through this stuff because Jillian already has a question about her 1031. We're going to roll that in.
Okay.
But right now, let's start with MVP Lee's question that he had. He says, I do have a question for Greg. Have you heard of the application Rent Tech? This app puts your data about rental income properties into a quick view dashboard. Does JWB use this or something like this for investors?
I haven't heard of Rent Tech specifically. I've heard of a number of the basically kind of like data making it easier for you to view your data. And I think that's a wonderful thing for investors. JWB has this as well. And this is a great time to talk about some of the improvements that we've recently made. Many of you already see our new portal that we have, our new portal, and it's available on mobile as well. So those are some nice improvements there. In fact, I was going to think about getting somebody on our team here, on our client service team, to kind of go into that, because we did a team presentation maybe like a couple of weeks ago.
TMM?
Yeah, a TMM, and we broke down the new portal that we have and the private lending portal that we have. So if you haven't reached out to your portfolio manager for JWB, and if you haven't logged into the new portal, I would imagine exactly what Rent Tech is doing here as far as putting information about your rental income properties right in front of you. It's going to do all that, and it's going to do a lot more. So reach out to your portfolio manager. If you haven't seen it yet, I think you're going to really like it. And, it is the beginning of the process for JWB. We look to make more and more enhancements into transparency and access to information for our JWB clients.
As AI starts becoming more and more like used in things, these like dashboard softwares are going to get better and better, right?
100%.
Because it's all about taking information from one place and then reformatting it in something else. And this like AI revolution is going to make that happen. I think it's kind of cool that you all were doing dashboards and doing these portals before it became, there's an app for that, right? So like, I think it's really cool. As an investor, I know that there's a lot of value in knowing where your money is and having access to it a few times that I've needed to know.
100%.
Marilyn said, is there also a new portal for private lending?
Yes, there is a new portal for private lending as well. So it shows you the loans that you have with JWB, the payoff dates. I'm sure there's a lot of other really great information. There's a difference between a dashboard with the vertically integrated provider providing that dashboard versus just a kind of a dashboard that's available out there, because they can't get access to all the real information that you have. They might have some, or you might have to manually upload it, but your vertically integrated provider who provides a dashboard for you can automatically churn that information out. So one of the things that I took away from the TMM, talking about the new investor portal for turnkey properties, you're able to see your lease end dates and your lease amounts and things of that nature. Those have been some of the requests we've received over the years. So those are things that you're not always going to be able to see for kind of like a regular standardized dashboard out there, but you'll get it with us.
Cool. Love it. All right. Next question is from Miguel Angel Sanudo, our hermano in Granada, Spain. He says, how has house pricing grown in the last 5 to 10 years in Jacksonville?
I don't have the data right in front of me, but, I remembered I looked at it not too long ago. I'm going to guess somewhere around 8-9% a year on average over the last 5-10 years here in Jacksonville. Now, the historical average is 4.6% per year, and that's prior to the last 2 years. So that's the 40 years prior to the last 2 years. So 4.6 is the historical average. But over the last, call it 5 to 10 years, we've seen almost double that over that time period. And that's, of course, because values were so low coming out of the Great Recession. So yeah, it's been an incredible 10-year run, one that I don't expect to continue. I don't expect people to continue to see 8 to 9% annualized home price appreciation. But, another great example of how you underpromise and overdeliver a lot when it comes to investing with the right team in the right growth market.
Got it. All right, JC, we got one more from the mountain man, Billy Green. He says, is there any market in the U.S. that enjoys the classical 1% rent rule that you know of?
So I get asked this question about this 1% rule. I'll be real candid with you. You could find the 1% rule in Jacksonville. If you want to go into low income neighborhoods and you want to do all the work yourself, you probably could find the 1% rule in Jacksonville. I think if the question is there a market where there is a vertically integrated provider out there who is investing in workforce housing? Is the 1% rule possible? I have not seen that in many, many years. But I'm sure you could find the 1% rule. If you're doing all the work yourself and you're willing to go into low-income neighborhoods, you could probably find that in any market out there.
Real quick, what is the 1% rule and what do you think about it?
Well, so the 1% rule is you getting 1% of the value of the home in rent. So, $200,000 home, you're getting $2,000 in rent.
Got it.
Just doesn't happen.
So rent to price ratio being 1%.
Yeah, there you go. 1%. Yeah. It hasn't happened for many, many years. I mean, I don't know the last time that it was a real thing. It's probably been over a decade. But you read books that were written, a long time ago, who are written for investors who want to be active and are willing to go into any neighborhood to do it. And it says, oh, think about the 1% rule. So when you change gears and you want to be in workforce housing, which is the right neighborhoods to be in for maximum value for your 5 profit centers, and you want to be passive, the 1% rule hasn't applied for a long, long time. And it definitely doesn't apply now. So simple answer to Bill's question, no. I don't know of any market out there that it has a vertically integrated provider that invests in workforce housing where you can get the 1% rule.
There you go. And the last question from Tuesday was from Anonymous Attendee asking, does JWB do any of the syndicated investing in major complexes in the downtown area?
Great question. We do not use syndications to make our investments in downtown. We've invested to the tune of about 20 city blocks in downtown Jacksonville. It's about 12% of the North Bank of downtown Jacksonville we own. It's about $42 million of our own money that we've invested. We do not take investor capital to do that. We don't do syndications. And there's a couple of reasons for that. The first is I want to protect your money. And what we're doing downtown, we're a pioneer downtown. We're taking down buildings that have been vacant for 30 or 40 years. These are $20 million renovations that we're doing.
Explain taking down.
Sorry. Taking down means we are doing the construction, tackling the project, doing the construction. We actually are preserving historical buildings. Thank you so much.
No, thank you.
Yes. We're preserving the historical buildings, but we are tackling the construction, and it's risky. And I come to you with investments that I've done thousands and thousands and thousands of times. And that's why I'm so confident I can take care of your money. Quite honestly, there's a lot of risk of what we're doing downtown. And I'm not going to take investor capital with that type of risk profile. And so that's a big part of it. The other part of it is that we are going to be in this investment for the long haul. If you take money as a syndicated arrangement, you have to build in the exit. You have to build in a 5-year or a 7-year exit. And that's not the type of decisions that we want to make. That's not what's good for our community and for downtown Jacksonville. And we have the capital to do it where we don't need to do syndication. So you don't typically see that for somebody, an early pioneer in a city. And for those reasons, we don't take syndication.
You have the capital to do it and the incentivization to do it, right?
Good call.
To me, that's why it's unique, because most of these, I live this in Miami, right? Like these syndications that come in that develop these pre-con things and sell you a bunch of stuff and they need to flip it in 5-6 years. Those developers are making short-term decisions and that's what they're incentivized to do. You guys have the benefit of, number one, because you yourself owns 300 properties around the urban core, you know that if you invest in the urban core and you can take a longer time horizon because you know that you're going to see the long-term appreciation for your properties.
Absolutely.
You also know that by investing in the urban core, you have another 4,700 properties that you manage and thousands of properties that you have sold to investors in that urban core. So therefore, you taking long horizon in your downtown investments makes your investors and your clients happy, because when the downtown pops, all of the surrounding urban core single family homes that you have sold to investors are going to, again, bend on that curve. And third, you have young kids that live here and you live here and you care about the city and you invested in the city. To me, that combination of incentives that afford you the long-term perspective, right?
Absolutely.
There's benefit for you to have this long-term perspective.
Well said.
Not an act of charity.
Sure.
That affords you this long-term perspective is what makes this whole equation particularly interesting to me. And I think particularly profitable for the city, for us as investors, for you guys as a company, and for all the stakeholders involved, which I think is what's really interesting.
Well said. Well said.
Yeah. So that being said, no syndications downtown. But if you want to invest in the growth of downtown, right? It's You don't have to buy the downtown syndication. You can invest in a rental property surrounding downtown that JWB makes available to you.
Let's do it for you.
It's like getting a stock in the city.
There you go. We're going to put you in a workforce housing neighborhood right around downtown, one of the key neighborhoods that we've been investing in since 2006. None of that has changed. We're going to put you in. We're going to do the same thing over and over and over again. And we're going to see similar results that other clients have seen for 17 years now.
Yep. And chatwithjwb.com is the way you get started on that. And now, GC, we get to get started in the portfolio. Let's start. I don't know if Jillian Noel's question is going to get answered immediately in this thing. So let's just say it immediately, because she came to the call with this in mind. I have a house that I was thinking about doing a 1031 exchange, but I would need to have my financing worked out too. The profit wouldn't be enough to pay it off. That is the part I forgot about. Are we going to tackle that in this thing, or is that
let me just give a little bit there. You're going to need to talk to a CPA. When you're starting to throw some things in the equation where your cap gains would not be enough, you can run into some tax implications there. So that's a great opportunity for you to reach out to my team or to a qualified intermediary who can help you here. If you want to reach out to my team, we can introduce you to, our contact, our qualified intermediary for 1031 exchanges, and make that connection for you. Of course, we're happy to do that. But when you start getting into some other particulars here, I'm not a CPA. I'm just a real estate investor who's done like hundreds of these. So for your specific situation, you're going to need to talk to somebody who has specific information about your 1031.
Cool. So you can go to chatwithjwb.com to get on the call with JWB. They can recommend you a couple CPAs. They can give you whatever insights they
100%.
have. You can elaborate a little bit more. Maybe there's something we're missing there that could open up some things. So let's talk about this example, GC. We got a portfolio of the week. Why don't you start describing it to me?
Yeah. So I chose this portfolio of the week because I thought, this is the way I come up with these, just so you guys know. These are, how they have like based on a true story in the movies. Every portfolio I'm bringing to you is like based on a true story. It's like a Hollywood movie that's based on a true story, right? These are conversations that my team has had, and we've talked through these things internally. And there's something really cool here to share that hopefully everybody will get value of. So when my team had this conversation this week, a client came to us who had a property, an 8-plex in Wisconsin. And he wanted to sell that property and move it over to a portfolio that's managed by JWB, so that he could have the power of a vertically integrated team. He did not have that at his previous property, but he did have a really good experience with his previous property. So he said, I want to move it over to JWB in Jacksonville because I like the team. I like the market a lot. Grows more here in Jacksonville than it has in his part of Wisconsin. And then he also subscribed to this theory, which is, I won't say it's either true or untrue, is that there's this theory out there that if you just been holding on to a property for maybe 7 or 8 years, things are about to really break and you want to sell that property. And so, with his experience and his previous property, he became convinced that that was going to happen for him. And he said, this is a great time for me to sell that property, move it over to a property here with JWB, again, that's been professionally renovated or newly built. And so for those reasons, he came to us and said, I've got a property that is about to sell for this 1031 exchange. How do I create the perfect portfolio where I maximize my tax savings from the 1031 exchange and I hit my cash flow number? Which that's, I think, the takeaway for today. We talk a lot about growth and returns. And when this client came to us and said, I want to maximize tax savings and I want to hit this cash flow number, our question was, what about growth? If we maximize your cash flow, we're going to be able to handle that. We can do that. But when you maximize cash flow, you give up a little bit of growth. Is that what you're comfortable with? And the client said, absolutely. He said, JWB, listen, I've got a number of investments out there and all of them are based on growth. And they're all supposed to pay off in 10 years or 15 years or whatnot. I don't need another investment that is max growth over 10 or 15 years. He said, the hole in my portfolio right now is cash flow. And the number for him is he wanted to generate $1,500 a month in cash flow. And I said, wow, what a cool learning opportunity, because we are here to build the perfect portfolio for you. For some clients, it's cash flow. And we're going to build and engineer that portfolio that way, which is what we'll see today. For others, and I'd say the majority of folks, it's more about long-term growth. And we build the portfolio a different way. So I thought this is a little bit different spin of how we can financially engineer something to accomplish your goals out there.
And this is why why we've made this change from the property of the week to the portfolio of the week, right? We want to teach this engineering, this money engineering concept better. Because when we're just talking about properties, people are just thinking about properties. We want to think about how you build a portfolio in this asset class that is a cash growth portfolio, right? So this concept that you can optimize a portfolio for cash flow now, you can optimize it for cash flow tomorrow, you can optimize it for growth, you can optimize it for tax savings, and whatever combination of this asset class is a lot more malleable than you think it is, right?
100%.
So let's jump into a GC. We got a spreadsheet here that we show total capital to invest is $510,000. That's what he's going to make when he sells this Wisconsin eightplex.
Exactly.
And what is this that it says here? Investment priority.
Yeah. So I wanted to put this on here because I thought as we're going through more and more of these portfolios, we can identify what is the biggest priority for the client who's coming to us. So we can engineer the perfect portfolio for them. So his priorities, he had two priorities. Number one, it was to maximize the 1031 exchange tax savings. And then number two, he wanted to have cash flow of $1,500 a month, year one. Now, in order to do that, he's willing to give up a little bit of growth. And we had that open conversation. And he said, this will help. This will fill a need in my portfolio. This is what I want. His investment time horizon is 10 years.
Okay, great. So then you have 10 years for this, prioritizing 1031 exchange tax savings and having more than $1,500 a month in cash flow year one, because he wants cash flow today, right? In 10 years. And you said the capital to invest is $510,000. Why is the total JWB investment $506,000?
Well, so when we talk with a client, we understand the capital they're bringing to the investments. We actually, of course, fill the portfolio with individual assets that have individual purchase prices. So it's very common that's not going to line up exactly with the amount of capital they have to invest, but it's going to be pretty darn close.
Got it. Cool. All right. So then talk me through this.
Yeah. So now in order to build this portfolio to, number one, maximize tax savings from the 1031 exchange and also maximize cash flow, you're going to see a portfolio here that's probably different than anything I've ever shared with you before. That's the beauty of breaking down the portfolio of the week rather than just an individual property of the week. So in order to do this, number one, we had to maximize the tax savings from the 1031. There's probably some folks out there that are like, what does that mean, Greg? Well, with a 1031 exchange, to get the full value of the 1031 exchange, you have to take the previous sales price of your property and you have to buy properties that are worth more than that in order to maximize the value of the 1031 exchange. If you don't, you will not get all of the tax deferral. There's a whole lot of CPA mumbo jumbo there beyond that, but just generally speaking, if the value of his asset was, he sold it for $700,000 before that eightplex before, then the total value of the properties he's buying with JWB have to have a purchase price of more than $700,000 in order to get the full value of the 1031 exchange. Okay.
Got it.
This is important because, if he just wanted to buy two properties with cash, then he would not have been able to maximize the full value of the 1031 exchange because his previous property that he sold was, call it $700,000.
Got it.
And so this was a cool scenario where we could sit down and say, you know what? We could get more cash flow if we just did two cash properties with that $500,000, but that wouldn't have received the full benefit of the 1031 exchange. How am I doing there? There's some tax stuff there. So
I thought, listen, man, I was able to follow it all.
Okay.
What I'm understanding is when you do a 1031 exchange, you're going to get this tax savings by moving your payout into another property in a certain amount of time with a certain amount of conditions.
Right.
And one of those conditions is that you move the entire value of the asset that you had before into something that has at least that same amount of value. Right. And what that means is that you can't sell a $800,000 property and then go buy two $300,000 homes straight cash because all you want is the cash flow. If you want to maximize the benefit of the 1031 exchange,
exactly,
you have to buy $800,000 worth of single family homes if the asset that you sold was worth $800,000, if that's what you're going to end up doing.
Yes. The only caveat is that it has to be a like kind asset. So you could sell a commercial property and then buy single family homes or apartment complexes or vice versa or whatnot. But yes, the value of the new portfolio has to be more than what you sold the previous property for. That's one of the IRS rules.
And that's going to play into the fact, into what you recommended for this gentleman, right?
Exactly. All right. So that's priority number one. We needed to put a portfolio together that had a higher purchase price than the previous price that he sold his other properties for. So instantly, as we're engineering this portfolio, we're like, okay, 2 properties with cash can't work. And so that's why you'll see here, his portfolio was made up of 1 cash purchase and then 2 conventionally financed purchased. What that does is by doing 2 conventionally financed purchases with roughly 50% down, and you assume each of these properties is about a $250,000 purchase price, that's going to get you more than $700,000 of a total purchase price. And that's how we were able to accomplish priority number 1, which is maximizing the tax savings.
Got it. Talk to me about this 55% down payment. You don't normally see this very often.
I know. I don't think we've ever talked about this, but I talk about this all the time when folks say, hey, what should I do for my portfolio? I'll generally give you a general answer, and I'll say, listen, your portfolio may be different. That's why you need to get on the phone with my team, right? That's why you need to go to chat with JWB.com. For this client, the perfect amount for him to put down to accomplish both of his goals was 55%. Now, why would we do that?
My guess is that if the goals were maximize the tax savings, that is how many properties you put down, and then the other part was cash flow, you had to buy down, you had to have a certain amount of income coming from, like, the mortgage has to be smaller.
Exactly.
Right. So the mortgage is cheaper, therefore you have more monthly cash flow. And that's why they put down 55%.
Exactly. The reason that we went to 55% is because we engineer this stuff, and we tried it at 40%, but at 40% down, he could have bought maybe more properties or whatnot, but his cash flow wouldn't have been high enough. It wouldn't have reached that $1,500 threshold. So every time we put a portfolio together for you, we can analyze this and say, okay, well, what are your goals? Do you need to get to $1,500 a month? Well, let's see what percentage down you really need to put down in order to get there. And then we can look at that and say, well, when we put 55% down, what does it do for your overall growth? Are you comfortable with that? How important is it to get to $1,500 down? And sometimes we go back and forth with the client. And that's the beautiful part of building the ideal portfolio for somebody.
I love that, man. I love those conversations, which is kind of, we talk a lot about, at least with me and my clients, and I just had this conversation with another client yesterday, this idea that when you were really trying to educate your market and your clientele, it's not just the results. Like, if you're just showing them results, that only shows so much, but it's the thinking and the process behind why you're coming to these results that are really how you get these aha moments for people to understand whether or not this is for them or not, right?
100%.
So like you explaining that, I find very, very valuable. Being a fly on the wall in that conversation, I would find very, very valuable. But the next best thing we can do is showcase these portfolios of the week so we can talk through these things and you can understand the different contexts that,
well said.
that makes sense for you or for somebody else in this asset class. So then we've talked through this idea that he had to have a certain amount of value that he was purchasing. And he also wanted to in order to maximize tax returns.
Exactly.
And in order to maximize cash flow, then the equation became, how much do I put down in order for my mortgages to be how little based on the cash flow that's going to come in. And in order to do that, he made the decision to prioritize that cash flow instead of what he could have done if he had a longer time horizon, needed less cash flow today to prioritize growth. And therefore, these are the results.
Exactly. And how cool is it to have that back and forth? We talk about how JWB is different. Do you think you're ever sitting down with a real estate agent thinking about buying a property and having that type of conversation?
Yeah.
No, this is not better. This is different.
Yeah.
Right. And this allows for incredible value for you long term.
Yeah, this is different. This is not like finding a construction team and a realtor. This is much more like sitting down with like a Kelly Barenbaum and having her break down, hey, we're going to put you in this many stocks, this many bonds. And this is truly like a financial advisor experience, but a advice on what you can do within a real estate portfolio to, pull different levers of growth and cash flow and risk mitigation in a certain asset class.
It's the same lens, the financial advisor lens.
Yeah.
Right. We are not financial advisors. I should say that, of course. But it's that lens. And all we're able to do is just put in different assets. We have access to different assets than a typical financial advisor does. Right. And the access to the asset class of single family rental properties is what we can provide for everyday investors.
Yeah, got it. Lita's asking, can you use land to do a 1031 exchange to single family homes?
I want to defer to the 1031 intermediary a little bit on this. I did some research because I thought I'd get some questions on this. And I found different articles online that said yes. And then I found some that were like, well, you got to check. So my answer would lean towards yes. I've never personally done one with land to an improved piece of real estate. But a lot of what Google told me last night said yes. But this is a great time. Either reach out to my team or to the 1031 intermediary that you have, and they can give you a more complete answer there.
I'm asking ChatGPT right now.
All right, there you go.
I'll tell you what it says. All right, GC, describe to me this total growth by profit center at 10 years. What this gentleman ended up deciding on.
Yeah, so we're able to give a picture of how much your value of your portfolio is going to grow from all 5 profit centers at the year that you tell us you need it. And it's that division by profit center. It's really illuminating. So we're able to look and say, okay, well, now we're doing this for that $1,500 a month of cash flow in year 1. But that's just the beginning. It's going to grow over those 10 years. After 10 years, we're expecting to deliver a little bit over $180,000 in net rental income for the client.
Got it. Beautiful, man. So you break out the different profit centers, right? We got the 5 profit centers, net rental income here, 180,000 because you're optimizing for it, right? Then you got tax savings in 10 years of 17,869. Principal pay down of 31,374, home price appreciation of 279,898. If I'm envisioning this right now, we talk about the Pac-Man, right? We talk about this asset class having home price appreciation as a big driver. And even if I do some quick math here, it looks like home price appreciation, 280,000, everything else about 220,000, 230,000, right? So this is just a Pac-Man with its mouth wide open. Even in optimizing for cash flow, being in a high growth market, the majority of your wealth is still going to get built off of home price appreciation, which is why high growth markets are where you want to be with cash flow. So
glad you picked up on that. That's 100% right. Even at 10 years too, if we built this out over 20 years, the Pac-Man part of this would get even bigger. It would get an even bigger percentage of how we're going to deliver these returns for this client. So this is the IRR, GC. So you just talked about the dollar numbers. This is the IRR. You want to talk about this? Yeah, absolutely. So we're going to take that $507,000 pile of money that this client's entrusting us with. We're going to use these assets, these single family rental properties. And over that 10-year period, we're going to return about $510,000. We're basically going to double the money over a 10-year period of time. So his total portfolio value, what this portfolio will be worth, according to our estimates, is a little bit over $1 million after 10 years. We're going to turn 500 grand into $1 million for this client. And based on the timing of those cash flows, his internal rate of return will be 8%. What do you think about that 8% number? It seems low in comparison to what we normally put out there. It is. Why do you think that is? Because you're optimizing for cash flow. Yeah. So when we typically talk about our returns, they might be somewhere closer to, call it maybe 9, maybe 10% now with interest rates where they are. So call it 9 or 10%. But for cash, it's going to be lower, right? You're not using the benefit of other people's money. And so as that asset grows from home price appreciation over time, you don't get as much of a benefit from that. You also don't get as much tax savings. You also don't get as much, you don't get any principal pay down. So with cash purchases, you go cash flow heavy and you give up growth. So for this client, they kind of did 2 things that were going to give more cash flow and lower the IRR. And the number 1 thing is they bought 1 property in cash. The number 2 thing is that the finance properties that they purchased, they put 55% down versus 30 or 25 or 20% down. And so this is a great example where if this client had different needs and said, Greg, I have $500,000 that I want to invest with you. I want you to grow that money as much as possible in 10 years. We could easily have put a portfolio together that would have been a, call it 9.5%, 10% IRR with a much bigger portfolio value, but that's not what the client needed.
Yep.
And it's one of the reasons I love single family rental properties as an asset class, because we can engineer it this way. It's one of the reasons I love the portfolio of the week now too, because this is the essence of what we love to do.
Yeah, this is awesome. This is awesome. This idea that this is, what I find interesting is that like a financial advisor that puts you in a well-balanced, risk mitigated portfolio with cash flow and stocks, their North Star is 7%, right?
That's what, that's what Vanguard says it's going to perform.
That's what Vanguard wants to do for you. And in rental properties, in a scenario where you are maximizing cash flow, right? And maximizing tax returns, you're giving up purposefully growth. You're still getting more growth than the average investor is going to get.
It gets even a little bit better than that, by the way. This is the original plan, but it's not as simple as that client saying, you know what, I'm just going to totally give up growth potential for the future. He wanted flexibility too. He said, you know what, this is my best laid plan right now. But I said, you know what, you're giving up a lot of growth by needing this cash flow. He's a high income earner, all that good stuff. I said, let me just throw something out to you. Let's say you get a raise, and the raise is worth $1,500 a month for you. So 18 grand a year, you get a raise. You got that in income coming in. What if interest rates come down in 2 years? What if you refinance out those properties again? Then we could really supercharge your portfolio. So this is the initial plan with this client, but pending life and pending interest rates and pending how things go over the first year or two, we might actually still supercharge that portfolio, and real estate allows you to do that. Yeah. Not many asset classes allow you to do that.
That is really cool. This portfolio serves this client in his current situation right now, and it's risk mitigated and it's got all the good things, and yet it still preserves an optionality to supercharge it for growth if his situation changes as well.
Exactly.
That's really, really cool. Yeah, that's the beauty of real estate. Dean Curry, the early bird, has been sitting there real patiently with a Q&A.
Love it.
Dean, we're going to answer this right now. Long question with a hopefully shorter answer. I want to buy another property or 10 with JWB. I have a prepayment penalty on some money that I would like to put towards the new JWB assets. The penalty time is up in 334 days. Question: what is the anticipated or projected increase in 2024 for JWB properties? 5%, 10%? Should I pay the penalty of $30K and buy a home this year, or wait until next year when there is no penalty? That's a doozy.
Dean, love the question. First of all, thank you for your trust, and thank you for, letting us know your goals, and we would love to help you get there. My first answer here is I would love to sit down and explore with you. Does it have to be an either or? Are there other ways that you can avoid paying this prepayment penalty, and we can find access to the funds for you so that you don't have to lose that prepayment penalty? And so that would be my first idea is let's get on the phone with my team and let's see if we can map this thing out and help you there. What is the projected increase? On our evaluations, we have 4.6% for expected home price appreciation in the Jacksonville market. That's a long-term general number. That's over 40 years of data. I take 1 year projections very seriously, because I think, number one, they're almost impossible to do. And so I put a lot of thought into it. And quite honestly, I do that really once a year for you guys, and so we did that earlier in the year. And, I think what we said was, highly dependent on the Fed. We said, we could see a decrease of maybe 5% or 10%, all the way up to maybe an increase of 5% in the home value for year over year gains. Now that was way long ago. That was probably 9 months ago, 10 months ago.
Yeah.
Lots changed. And, I would say that it's more towards the higher end there, but I'm really going to hesitate from saying just a percentage number. I don't want to get flippant with that. I think that really matters to you all. So, you know what? Each year I'll give that to you, but just long-term here, I think you're going to be, let's try to figure out a way for you to not have to pay that penalty and then continue to add to your portfolio. I don't know. Let's try that first.
Yeah. Okay, cool. So I would assume that what Dean is the the variables in that equation are what are Dean's goals, right? It's also going to be what are these properties, like how much money is he going to be able to pull out of this property so that you know how much that 30K, if the 30K is the penalty, you're going to want to know how much that penalty is versus like how much upside he's going to get from this money long-term versus downside.
Yeah.
So there's a little bit of holes to fill in there as well. And then there's going to be a little bit of guesswork on what is the economy going to do in the next year.
Yeah.
Right now we're hearing soft landing for the economy. It looks like things
It's
are
much better.
looking pretty good.
I should probably just let everybody know that home values in Jacksonville are up year over year. So when we said, hey, we could see values going down 10%, we were way off there. We were way off.
Yeah,
Home values are up this year. So I should probably not just leave that hanging chat out there.
Yeah.
Home values are up. So, but if I'm not going to, I don't know, what you would need to figure that out is you'd need a number of exactly what you think home price appreciation is going to be next year versus the cost of the prepayment penalty. And, I don't know about that. So I would say,
sounds like a conversation.
Let's have a conversation. Cool. Let's start there.
Sounds good. All right. The shaman, Nadeem Shah of the Not Your Average Professional Community says, can one do a 1031 exchange if one still has a mortgage on the property?
Absolutely. Yes.
Absolutely. Yes. By the way, update. I asked ChatGPT if you can do a land to single family home 1031 exchange. It gave me a whole long answer with 7 different requirements that you need for a 1031 exchange with a caveat of not being a tax advisor. And then I responded, so is that a yes or no? And it said, yes, you can do a 1031 exchange between land and single family rental homes as they can be considered like-kind properties under the U.S. Internal Revenue Code. However, it's crucial to ensure all other requirements of a 1031 are met and to consult with tax professionals.
Like that. That's kind of what I was getting at.
Yeah, it sounds kind of like you. And Mariana Camacho has a question for the community and for maybe you, GC. Hey, team, looking for any helpful advice or experience with your investment properties in septic tank. I hear good and bad things on it, such as a high cost to replace in near future, maintenance cost, etc. Are city sewer investment properties best? Any input on that would be appreciated. She put it in the chat. She's getting some responses from the community. But what say you, GC?
Well, I'll tell you what I do with my own portfolio. I have a lot of homes that are on septic tanks in my own portfolio, and they've performed really, really well over the years. Just like the properties that are on city water and sewer have performed well over the long haul. The main thing is when you buy and hold single family rental properties over the long haul, it's hard to lose. So that's just a general statement. Septic and sewer is just like any other cost, any other line item. As long as you understand what the typical costs, the typical maintenance costs are of a property with a septic tank are, then you can account for that in your projections, and then you're prepared because overall, you may find that you might have an extra expense when it comes to a septic property. Like, for example, there are annual septic fees with certain types of septic tanks here in Jacksonville. And so if you know those fees in advance, you can put that onto your evaluation, and then there's no problem with investing in a septic tank property. If you don't know the fees and you don't know the expected maintenance costs for a septic tank property, that's where people get into problems. So yeah, I have a ton of septic properties in my portfolio. It's not a qualifier for me. The big thing is, again, number one, do you have the right team? Are you in the right market? And when it comes to the property, just make sure that your projections are based on real data that either you have or that vertically integrated provider can provide for you so that you can make an educated decision. But it's not something you have to stay away from.
Good stuff, GC. I thought this was good, man. So listen, the main takeaway of today's call, after all, we handled a bunch of Q&As. I like this format, by the way, like being able to cut off Tuesdays, keep it an hour. We can not get hangry, and then continue with the Q&As here on Thursdays. I really, really like it. We're going to continue to do that if we run over.
Love it.
And I'm sure we're going to run over next week, because next week is what, GC, on Tuesday?
Man, that is the quarterly real estate market update by yours truly. I'm super, super fired up.
Yeah, I love it, man. That is always our most attended call. It is always our most downloaded podcast and YouTube episodes.
It is.
So show up for some great value for what GC and JWB's data can tell you about the current state of the Jacksonville market, the current state of the economy here, and what we see in the short term here and what's happening. And of course, the KPIs and the indicators of whether or not JWB is doing well or not. Spoiler alert.
There you go.
It's probably pretty good.
There you go.
That being said, today's lesson is when you look at this thing as a portfolio, when you look at real estate as a portfolio, and you think about it as a financial engineer, you are able to optimize for different goals, just like any other, just like, when you talk to a financial advisor, they can mix bonds and stocks and different things to give you different exposures to things and cash flow and upside and whatnot. You can do that with a portfolio. So with a real estate portfolio, as long as you have the right partner. So today what we did is we saw somebody that had a property that they were selling in Wisconsin for, $800,000, $700,000 of the property. That was going to give them a financial windfall of about $500,000 and change. And they wanted to maximize their tax savings from the 1031 and also get to a monthly cash flow number year one of $1,500 plus. The average advice would have been like, well, you can either buy this property or that property or not. But the not your average advice was with one property in cash and two properties financed with 55% down payment. Now you were able to get to that number that you needed to get to qualify for the 1031 exchange. And you got to have a mortgage that was cheap enough to maintain that cash flow of $1,500 per month. And you can do stuff like that when you go to chatwithjwb.com, work through those options, work through those different types of things, and build a portfolio that suits your needs in real estate. What do you think, GC?
I think you nailed it, bro. This has been a really fun experience here. I feel like me and you have just, we kind of been building up to like being able to deliver this well. I mean, it takes an incredible amount of knowledge and experience on your front as well. And I think this is the avenue for us to really give the essence of what we're trying to do here, right? We are not trying to, spend a whole lot of time falling in love with one property. We're trying to take your money and make it grow or make your cash flow grow or do both. And so, yeah, I'm really excited. I'm excited that you guys are loving it too. 60, 70 folks here at one time. So thank you guys for being here. You guys make this super, super special.
Yeah. And we hope to see you all on the JWB quarterly fiscal year update thingy. What do we call it? The quarterly report, the state of the Jacksonville economy report. But from now till then on Tuesday, what do we got to tell them? Do you see?
Don't be average.